A multi-pronged crisis is coming. I'm your host, Steve Metre, and thanks for joining me today. And the World Trade Organization is warning that a global Great Depression is imminent as trade volumes collapse. Let's over to the Wall Street Journal, where we picked today's story up with the headline, WTO sees sharp slowdown in global trade, pointing to possible recession as high inflation and borrowing costs, supply disruptions are weakening global demand for exports and imports. World trade in goods is projected to slow sharply next year under the weight of high energy prices, rising interest rates, war-related disruptions, which are raising the risk of a global recession. But there's one thing you note that they're missing here in this story is all of those goods that wholesalers and retailers ordered, and they're coming through the supply chain. What we're seeing is over-ordering and a decline in demand. So, they still miss. Too many orders are on their way in. As total exports and imports of goods are likely to grow by just 1% in 2023, as the World Trade Organization said on Wednesday. That would be down from its previous forecast of 3.4% and its forecast of 3.5% for this year, marking a sharp slowdown. The WTO also lowered its forecast for global economic growth in 2023 to 2.3% from earlier expectations of 3.3% and warned of an even sharper slowdown should central banks raise interest rates too sharply in their efforts to tame high inflation. But as we talked about in yesterday's show, the rate of change in central bank tightening, when we look at, say, the federal funds rate and you look at the increase in foreign central banks, their policy rates, we can already see the seeds have been sowed for a massive recession. The global economy faces a multi-pronged crisis, according to the Director General of the WTO, noting that the picture for 2023 has darkened considerably. The U.S. trade picture in August reflected a broad slowdown in demand as exports of goods dropped 0.3% in August from a previous month, the first decline since January, according to the Commerce Department. Goods imports fell 1.5% during the same period. Now, it's important to understand when we talk about global trade, not only is it a good leading indicator, but when global trade is expanding, then the global economy is growing. When it's contracting, well, what we see is just the opposite effect, and the likelihood of recession becomes very high. When including both goods and services such as tourism, education, and healthcare, total U.S. exports fell 0.3% in August from July, while imports decreased a whopping 1.1%, a big number considering the U.S. is the largest importing nation in the world. Because imports fell more than exports, the nation's trade deficit shrank 4.3% last month. The strong dollar, which we've talked about on the show repeatedly, makes imports cheaper for U.S. consumers while making American products more expensive for foreign buyers. So what we should be seeing here is a demand for foreign-produced goods by American consumers because they're cheaper. But because there's not a lot of demand, wages are not keeping up with inflation, the economy is slowing. What we're seeing now is just the opposite, sowing the seeds again for that great global depression. And here we can note in the trade balance, goods and services, this is a trade deficit chart. When you can see as the blue line heads lower, that is an increase in global trade. When the blue line goes up, you'll note those gray shaded bars start to show up a recession. You see it here during the dot-com bubble, the great financial crisis. We see it going into the pandemic. As we note before, we were already headed into a recession. And now note this sharp change here telling us exactly where the economy is headed, and the picture is not good because every time we see global trade contract, we get a recession. And there's one thing that shouldn't face a multi-pronged crisis, and that's your portfolio. I'll put a link up here for portfolio and description below, because if history is a guide, we're about to see things get much worse. And as speaking of getting worse, here in America, gas prices are climbing again and may get worse, and that will just cut into demand from U.S. consumers as more of their money goes into gasoline and energy prices. But what's causing that is maintenance of fuel-making plants. More demand for gasoline and tight fuel supplies have contributed to a 14-day run of increasing gasoline prices, which now have averaged $3.81 $3.83 on Wednesday. An decision by the OPEC and its Russia-led allies on Wednesday were going to cut production by 2 million barrels a day will further elevate prices, according to some analysts. The White House saying the decision being short-sighted. Well, the issue with OPEC is they're not even meeting their production goals now, so really a cut may not have any effect. But this hasn't changed, again, how the White House is viewing this. And let's check out this story again from the Wall Street Journal. As Biden weighs options after OPEC Plus moves to cut oil output, Congress and White House consider retaliatory measures such as suing the cartel on antitrust grounds. The U.S. lawmakers are pushing bills that aim to break up the cartel, charge it in front of the World Trade Organization, or even seize assets its members own in the U.S. I don't know about you, but I'd love to know what your thoughts are. Do you think we'll be successful? Do you think Congress will push those bills through? Well, I'll let you weigh that in the comments. I think I'll be a little skeptical on that one. But other things that we're facing a headwind in the U.S. economy, which are leading to decline in trade, well, layoffs are coming, and here you can see just the beginning. Amazon freezes corporate hiring in its retail business as it instructed recruiters to close all open job posting for those roles in the coming days and recommended they cancel some recruiting activities such as phone calls to screen new candidates. And how about Peloton? Well, they slashed 500 more jobs as they race to return to growth. The cuts, which amount to a whopping 12% of their workforce, mark a pivot point for the company. Peloton has already had multiple rounds of layoffs this year as demand continues to fall. And where we're seeing this, what we should then see eventually is initial jobless claims rise, although last week could be due to Hurricane Ian. But we'll note that initial claims rose 29,000 to 219, which remain very low. State claims up 15,000 to 1.361 million. But of course, from the Fed's perspective, remember, they've talked about they want to see an increase in unemployment claims. They want to see an increase in the jobless rate. But are they going to get it right? Well, probably not. The Fed has a poor record of forecasting joblessness around downturns. The current prediction is unemployment rate of 4.4% at the end of 2023, but 50 years of history shows the Fed can't get it right. Fed officials have failed to correctly predict how high joblessness will increase during or in the wake of almost every recession over the past 50 years. In 3 cases, 1975, 1982, and 2009, the unemployment rate surpassed the Fed's near-term projections by about a percentage point or more. And you think about why this happens is because it's very difficult to predict how businesses will react. You start to get a financial crisis, you start to get panic, and it becomes increasingly easier, particularly when you don't have a lot of labor unions, to just shed jobs. The Fed, of course, can't see it coming and always gets it wrong. Recessions are famously difficult to predict, according to the U.S. economic research by David Wilcox. When the economy starts to weaken, a different dynamic takes over. But there is one dynamic that hasn't changed, and that's the view of our chief strategist, Jeff Snyder, who writes in his daily, and I want to note, there is still a discount until Sunday midnight, 50% off. We just put out a trade tip today for our subscribers. And again, if you subscribe to Markets Insider Pro, link in the description below, you get a special discount to Jeff's deep dives. Again, Sunday midnight goes away. What he talks about is, according to the private payroll services ADP, as we mentioned on yesterday's show, employment increased by 208,000, which sounds pretty good. But he notes, beginning with the prior month's revision, the ADP figure for September ends up like the JOLT survey in no man's land. All it confirms is the U.S. labor market has slowed down, leaving the crucial questions unanswered, either because of short-term variations or inconsistencies, even doubts concerning the data accuracy. He notes that September's estimate has been viewed as positive since it didn't go lower, which just means there's less evidence for a sooner end to the Fed's rate hikes. Of course, we don't have that meeting until November, but we'll see how things can change. And they can change quickly. And if anything is an indicator, this decline in global trade is a big red flag that the entire world, which had a synchronized expansion from the pandemic, is now facing a synchronized contraction. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.